The software apocalypse continues.
At least as of this recording.
Yeah, maybe by the time you watch this video, software stocks have completely recovered.
Yeah, maybe they've regained all of February's losses, but we doubt it. We think we probably have some time on this one, so here we go.
Are we buying the dip on AppLovin?
In this installment of the best use of AI so far, still digital ads. It feels like a bad rerun, but seriously, digital ads are where it's at.
Wait till the end of the video where we share whether or not we are adding to our AppLovin position. But first, a shout out to the sponsor of today's video, Fiscal.ai. We're recording this video just a few moments after AppLovin reports, and we already have charts. We already have the data in Fiscal.ai.
It's a fantastic feature in Fiscal's platform for analyzing businesses. You also get sources to that information as it gets updated, built into the platform. As an investor, it's a difficult endeavor trying to figure out what platform you can trust for your financial data. Fiscal does a fantastic job at this. It's why we make them part of our research every day here at Chipstock Investor.
You can get 15% off any paid plan, including their pro plan, with this unique link here on the screen, fiscal.ai/CSI. Let's dive in and look at some of those great fiscal charts.
This is the latest installment of what AI is best at. And unfortunately, it's still digital ads. And AppLovin, more like cheat code type financial performance here, totally crazy. The stock has dipped. We'll talk about why that is. And as we're looking at making software purchases, we ultimately keep coming back to the tried and true business model of the internet era, which is also probably going to feature prominently in the AI era, digital ads.
Let's take a look at the guidance for first quarter 2026 and compare that to what it was last year. And it looks pretty great. Fantastic financials.
Yeah, I don't think this is too much of a confusion anymore, but we figured we still need to call it out anyways. Remember in Q1 of 2025, they had not divested their app video game developer business yet. And so that's highlighted in orange in Q1 2025 actual results in the bottom part of the slide. So we're excluding apps revenue of $325 million and apps adjusted EBITDA of $62 million for the year-over-year comparison to the Q1 2026 guidance, because all that's left now is just the Axon and related digital ads software business. So that's why we have the apps highlighted in orange. We've excluded that when coming up with the guidance expectations for Q1 of this year.
So excluding that, at the midpoint, Q1 2026 expected revenue and adjusted EBITDA guidance implies year-over-year growth of 52% for the revenue, and adjusted EBITDA is 56% year-over-year increase.
Yeah, and lots of issues with adjusted EBITDA, but it's for comparability's sake. It translates roughly over to free cash flow, which we'll show here in just a minute. But the big takeaway here is the continual increase in adjusted EBITDA margins up to 84%. We were looking at this when it was in the high 60s and then later the high 70% range and thinking, how much cash can this business continuously convert to the bottom line? And they keep finding ways to do more, even as they're in the early days of expanding into e-commerce outside of the core mobile video game digital advertising platform. Pretty crazy margin expansion continuing to happen here and lifting that adjusted EBITDA profit higher.
Yeah, absolutely. And we've been getting a ton of questions about AI, how it's going to affect software. And if we think we're getting a lot of questions, the CEOs of software companies are certainly getting even more questions about that. And this is CEO Adam Feroughi on the earnings call. This is an interesting take. I like what he said here. AI is actually going to make games easier to build, which some may think that that means that the ecosystem declines, that things will actually be much harder for a company like AppLovin. But according to him, they believe the exact opposite there. What they believe is going to happen is that there's going to be more opportunity for people to create more and more content. But because of that, there's going to be so many options for apps They need to match the correct app and the correct ad with the correct person, which actually would be, in their minds, more of a value proposition.
It makes sense. They are an AI-based advertising platform. That is the strength of the AppLovin Axon 2.0 suite of algorithms, which continues to be a black box, but that is digital advertising. These are proprietary algorithms. Meta operates the same way. Google operates the same way. They're, for competitive reasons, never going to tell you how this thing actually operates. But the more supply out there, the more opportunity they think they have to make some money by pairing the app developer with their most ideal user or gamer. So I think at this point, if you're not comfortable with the fact that this is a black box business, if the financial proof is not enough, this maybe just isn't the right business for you to be invested in, because the proof is definitely here, right here.
Whoa. The year ending December 2025, almost $4 billion in free cash flow. And it was just over $2 billion in 2024, almost double.
Again, this looks crazy, but still, AppLovin is a pretty tiny business when you compare it to the really big digital ad platforms of Alphabet and Meta, even Amazon advertising. I think this kind of stuff, for some reason, makes investors uncomfortable, not knowing exactly how it works and how this is translating into such high free cash flow growth. But that's really not new, uncharted territory if you've been invested in the internet consumer businesses all along. This is just kind of how these things scale, especially in the early days. Pretty crazy. Balance sheet. Over the last couple of years, this was a point that we called out as a potential risk. They took out that loan a few years ago when the bear market started repurchasing tons of stock, used up all their cash. And now that they're free cash flow positive, all the share repurchases are happening with free cash flow, which means any excess free cash flow plus the sale of the apps business is translating into cash on balance. So we're almost back to parity now at this point, with total cash reaching parity with long-term debt. This is a very healthy balance sheet again. And then here's a look at shares outstanding, the stock-based compensation, which they've driven down, not just as a percentage of revenue, but actually in absolute terms as well, driven down. And then the stock repurchases. This is pretty good stuff if you like shareholder-friendly businesses. This is great.
Nice looking charts.
Yeah.
What about on a free cash flow per share basis? Whoa, $11.61 at the end of last year. Big ramp up in the last couple of years on free cash flow per share.
So we're not getting the huge bump in this metric from the share repurchases. Again, another item we called out last year because the market cap has gotten so big. It's more than 100 billion. The share repurchases are not going to be as dramatic of an effect like it was in years past during the market downturn in 2022 and 2023. But still, this is what you would expect to happen and continue to be a benefit from a long-term compounding business, compounding machine.
As you mentioned, the stock price has come down quite a bit, taken a bit of a hit. So let's look at this. This is post-market. It's fallen a little bit more. $448 is where we ran this reverse DCF using free cash flow per share, $11.61, growth rate of 20% for 5 years, terminal growth rate of 5%, discount rate of 10%.
So if you lower the stock price, fair value down to 420 or 415, obviously the growth rate for the next 5 years also has to decrease 1 or 2 percentage points, 18% or so. A lot of this free cash flow growth over the next 5 years in this scenario actually happens in year 1, which is interesting. And then, of course, if the stock falls even further, if it even goes below 400 again, like it did very briefly in the last couple of weeks during the AI software apocalypse, the thing happening in the market, the expectations get even more reasonable. So the market really trying to not just wrap its head around AI and its effect on software in general, but also AppLovin. Can they actually generate the same type of long-term growth from their entrance into e-commerce? The market's baking in a dramatic slowdown at some point from the mobile app platform as well. But I think for us, the reason why I just left it at the market close price of high $440 range before another sell off was I feel like that's kind of a natural anchor point at this point, just looking at what the market has been feeling about AppLovin in recent months, keeps getting hit with short seller reports. Obviously, anything below that, I think we're of the mind this is something that we would like to nibble on, even though fastest ever position to reach a top 10 position for us when we originally bought it 2 years ago. So we don't need a huge purchase, but this is a winner that we feel like is showing signs of continuing to win, even though it's still only a 2-year position for us. So I think we would like to take a nibble in the low 400s, definitely if it dips below 400, and just kind of let this thing pan out and see what they're able to do.
Although there's a lot of cheap stocks in software right now, there's a lot of momentum in the memory market. We're carefully following this as it progresses. Check out this latest video that we did on SanDisk.